Ladies and gentlemen, good day and welcome to the Q4 FY22 earnings conference call of Sterling Tools Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vijay Gyanchandani. Thank you, and over to you, sir.
Good morning, everyone. Welcome to Sterling Tools Limited Q4 FY22 earnings conference call. From the management today, we have Mr. Atul Agarwal, Full-time Director, Mr. Jaideep Wadhwa, Director, and Mr. Pankaj Gupta, CFO. Now I request Mr. Pankaj Gupta to take us through the key remarks. After that, we can open the floor for Q&A session. Thank you, and over to you, sir.
Good morning, everyone. Thank you for joining our Quarter 4 and full year analyst call. May I request Mr. Atul Agarwal, Promoter Director of Sterling Tools, to give the opening remarks.
Good morning, everybody. It is good to meet all of you, albeit it's an audio call. I wish we could do a video call, which we'll try and do going forward. For Sterling, this is a new beginning for us. This is a new initiative we have started. This is something we have set up this new investor communication format, and hopefully we hope to reinforce that and make it more consistent going forward. Let me just dive into the agenda for the call. I think Sterling, everybody must have seen the results which we announced yesterday. We were plus 30% on top line revenue. I believe our growth has been probably faster than the industry grew across all segments. And I think I would attribute that to the very hard and diligent work the team did across all functions, from sales to operations. And we hope to maintain that vigor and that enthusiasm and that aggression with our customers in this financial year as well. Despite the headwinds we had last year, one main was lack of semiconductor availability, which impacted our customer production lines, namely all the key customers we work with. There was an opportunity from a market growth perspective for sales to be higher for all our customers, but they were all impacted in their production capabilities for lack of semiconductors. Having said that, there were also two-wheeler industry did not do very well last year. I think since 18-19 is been on a negative trend, and it's being impacted for various reasons. One is economics. I think COVID has a huge impact, and also there's a certain bit of latency wherein the customers are probably looking to buy more EV vehicles, e-scooters or e-motorcycles, moving away from what they do currently. And I think Jaideep will talk about that more in the latter part of the discussion. So we have an initiative which we had launched a few years ago on e-vehicles, where we do motor control units. We have some good news which we had last year, and we see a lot of momentum going forward in that business. I think commercial vehicle industry had a positive growth last year, which is a good sign because that's a major contributor for our sales. We work with all the key customers there, and we hope that momentum for CVs will continue this year. A couple of concerns. I think Pankaj, our CFO, will get into more detail with you on hard numbers, but we grew 33% roughly, top line, on a standalone basis for our fastener business. But our margins were under pressure, and I think margins were under pressure for bulk of it, I would say, for reasons beyond our control. We were able to get full compensation of steel price increase from our customers, but we were not able to pass on the conversion cost increases because of inflation. I think energy, chemicals, all construction, all conversion materials went up dramatically, and we have not been able to pass on the cost to our customers, or we not be able to get increases on account of that. So that's why there's a drop in our margin structures at an EBITDA level. And second, also there's also a numerator-denominator effect, which Pankaj will explain to you, because if you're getting full compensation on steel prices, it's just pure mathematics which impacts the way the numbers look. But I'm not unduly worried on the fall of margin numbers. We have seen this in the past also. I believe when things start softening up, margins will go back dramatically up again. And secondly, we are expecting a huge growth this year. We have launched some strong cost control measures in-house, some efficiency measures in-house. So even if things stay constant from a cost perspective, we hope to deliver better margins going forward this year on the same cost structure itself. I'm not going to take too much of your time. Lastly, we have a healthy balance sheet, and I think we declared a 50% dividend for FY22 in continuation of what we have done in the last couple of years. We believe that we have a strong balance sheet, but we want to have cash on the books. COVID is still not played out fully, and the Ukraine war and other inflationary measures are not played out fully. So we rather have a strong company balance sheet with a lot of cash on the books. Our net debt position is almost zero, so we are basically a cash positive company. So we like to work with that strength, and so that we are able to address any uncertainties which may come going forward. I'm going to hand over to Pankaj for a little more detailed numbers, what he wants to get into with you guys.
Thank you.
Over to you.
Thank you, Atul. So once again, welcome, and short commentary on the results for this quarter. You can refer the investor presentation available on the stock exchange site. So just to sum up the year, I think FY22 has been a very strong year, we will say. A good revival after, uncertainties of COVID, unlike in FY21, So I'll say a good year to bounce back. We had 33% revenue growth with about 9% growth in EBITDA and 22% growth in the PAT. So in spite of all challenges which Mr. Atul shared just now, yes, margins have come under pressure, mainly because of two reasons. One is more mathematical, which is a pass-through of the steel, which percentage margins, gets affected. But however, commodities have like power, fuel, chemicals, and because of freight, for that matter, have really eaten away a portion of margin, which we are working. As Mr. Atul said, there is a plan to go back. We are confident that we should go back to the margin level which we used to be a couple of years back. We have very low debt, and we keep cash in books for the rainy days. All the leverage ratio of the company, DSCR 3, current ratio 2.2, a very strong balance sheet, A1 plus rated on short term, and AA stable for the long term by ICRA. We generated about 57 crores of cash. We have almost done with our capital expenditure on fastener side, and we see the balance sheet becoming healthier in the years ahead. And I'm very happy to share a very important event which management vision, I will say, was to see that there is a limitation to fasteners can grow to a level, and we saw changes in the industry shifting to electric vehicles. And that is where 3 years back, we, with a small vision in mind, formed Sterling G-Tech, a company in a technical collaboration with a Chinese major player. Happy to share with you in FY22 when we closed, we did a first time a sale of 38 crores, that also in last 3 months only, and for the high-speed two-wheelers for major player in the country. So very a good diversification, a good addition of top line in this year, and very exciting order book position year ahead. I'm very happy to share that. And Mr. Jaideep Wadhwa, the CEO of this division, is with us. I'll request Mr. Jaideep sir to give us more insight on this business.
Good morning, everyone. So the electric vehicle business, as we talked about, is something that the company Sterling G-Tech was formed in 2020. We've been looking, however, at the space we had been looking at the space, however, for at least 2 years before that, and had done a lot of work on identifying areas that we wanted to participate in. We had some criteria on what how we wanted to play in this space. One of the filters that we employed, for instance, was that we wanted to play in areas that involved both firmware and hardware, because we feel there's a differentiation that the firmware component brings. On the hardware side, it may be electronics, but it's still commoditized, and therefore, through a lot of vetting and through a lot of discussions and going back and forth with potential customers, we picked up as one of our first product to start in the electric vehicle space is motor control units, which, as you're probably all aware, is the heart of the vehicle. It controls the motor, involves power electronics expertise and obviously firmware expertise, because it's about managing the switching between the from the DC current to the AC current, but more importantly, the interface with all the other drivetrain components in an electric vehicle. We secured our first order last year. This was an order for 60 crores. We have since then got confirmed orders from 10 customers. Our total order book today is 175 crores, as mentioned in the presentation, and we continue to be engaged with close to 30 customers across a variety of automobile products. So the bulk of the traction that we are getting is in the high-speed scooter space, but we do have programs in the low-speed scooter space. More interesting are our programs in the three-wheeler space, both in cargo as well as passenger vehicles, and we've also now had some success in light commercial vehicles. So, in terms of ratings, if for those of you interested, our current activities are from 1 kilowatt to 50 kilowatt, though our portfolio goes up to 200. But where we have where we have customer traction is between 1 kilowatt and 50 kilowatt, and again, the bulk of the voltage, bulk of the products that we are working on today play in the low voltage space, below 60 volt. But we are doing 336 volt, which is the platform that is used in passenger vehicles and light commercial vehicles. So, interesting space. We hope to stabilize this business, looking at very good growth in the coming year. Definitely, to give you some projections, not projections, but just give you some idea of what we are hoping to do. We finished last year at about 10% of group turnover. We expect that to reach about 30 to 35% of group turnover. So that 30 to 35% of the group's turnover will come from electronics products for the electric vehicle space. Our revenue numbers, we are looking at a 4x and more growth potential right now. We continue to look for additional products to add to our portfolio, and as we get more traction with existing and new customers, we are looking at the possibility of introducing additional products so that we can be a full service provider to the electric vehicle industry. That's a very quick update on where we are, and we'll be very happy to take questions on the fastener business as well as the motor control unit business.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Viraj Mehta from Equirus PMS. Please go ahead.
Yeah, hello sir, and congratulations for good set of numbers. My questions are a little bit more basic, so pardon me if they sound a little less knowledgeable. Sir, first thing I wanted to ask was, out of the current portfolio, and you have given a breakup in your presentation. If I understand correctly, 22% comes from PV. How much? So your majority of the revenue that you talk today, which comes from EV, directly comes only from two-wheelers and nothing else from anywhere else, right?
No. I think let me clarify. I think we have a revenue. We work with all the. Let's say we're talking about the partner space. So in the partner space, we are working with customers across all segments. Starting from two-wheelers, we work with market leaders like HMSI. In passenger vehicles, we work with customers like Maruti Suzuki. In commercial vehicles, we work with customers like Tata, Mahindra, Ashok Leyland, Daimler, Volvo, etc. And in the tractor business, we work with Mahindras and John Deere, along with the last segment being a singular customer called JCB for off-highway vehicles. So we have presence across all highway. Pankaj, you want to tell the numbers for different business segments we have and what percentages?
So yeah, a fairly diversified portfolio, Mr. Raj. So we have two-wheelers, which accounts for roughly 18%. Passenger vehicles, we have another 22% coming. 19% is attributed to commercial vehicles. We also have presence in the farm equipment side, which takes care of 17% roughly. And then another two markets, retail and export, totals to around 25%. So two-wheeler is only 18%, not the major.
Okay. And sir, if I look at the commentary of some of the CV guys, they are talking about a number which is higher than 2019, and they're seeing that kind of traction for the first time in 3 years, at least in the first 6 months of this financial year. Are we also seeing similar kind of traction?
Yes. So I think we are seeing similar traction. They are talking about matching their numbers of 18-19, which was the biggest ever year in the CV industry. For our sake and their sake, we hope it comes true, and that is why we believe we have our numbers we are looking at next year are very strong. If currently our CV business is about 20%, we have huge capacities in place to address the opportunity which CV business will present going forward. And we are looking forward that segment of the business going up substantially. In fact, if we are looking at growth next year, a large part of that growth will come from the CV segment itself. So we are also in sync, but 18-19 numbers, I think is a tough ask from a CV industry perspective. But even if they come close to that, that will be a big jump from where we are right now.
Right. So, sir, can you guide a little bit in terms of overall revenue perspective? We ended the year with 475 crores. Are we looking at 20-25% growth here? And if that happens, how much operating leverage do you think there is in the system if that kind of growth does come through?
Pankaj, you want to take that?
Yeah, I mean, in terms of top line, if you see, yes, in fasteners we have done 475 crores of turnover. Of course, we are ready for much bigger numbers. In fact, this year had challenges of semiconductors, so we missed the target by a couple of percentages. But going forward, yes, we are ready for. And in terms of operating leverage, what you are saying, definitely. After a certain threshold, whatever increases, will definitely increase my margins and bottom line. I think that is what your question is, right?
Right, because see, we are looking at a 5-year low EBITDA margin. Your 21% EBITDA margin in FY18 has been like now 15.5%. So is it fair to assume that these are like bottom margins now?
Yes, I'll answer. It's a good question for the benefit of the audience. See, very important in our business is to see the steel is a pass-through. We get the increase from the customers with some time lag. However, I mean, in my financial, if you see like the 4-year, 5-year trend, it gives a concern that there is a 3-4% drop or maybe 5% drop in the margin. But trust me, more than 3% on this is on account of mathematics only. So, like just to give you a perspective, suppose the steel price goes up by 17,000 rupees a ton. just add that to the top line and bottom line, that just answers 3% drop in the margin. So vice versa, if there is a softening on the prices, my margin will go up and you will say company has done fantastically well. But the fact is fundamentally nothing has changed. So this is first point to take a note of. Second, the increase in the commodities because of war situation, because of various macroeconomic reasons, every industry is suffering, and this is something which we don't get a easy compensation from OEM. It takes a lot of effort and time, and many times it doesn't happen. So it is left to the company to be more lean, more efficient, and curtail costs wherever, waste elimination, and recover these margins through your efficiencies, which I think as a ecosystem of Sterling, we are very much on track, very much aligned, and are confident, as I was saying in my opening remarks, that we feel that with all our efforts, maybe not immediately, but we should go back to 17-18% margin, which we used to have earlier.
Right. And sir, my last question will be from your EV, I mean, as in the non-fastener business in this year was only around 40 odd crores, but you have an order book of 170 odd crores. So all of it is executable this year, or that's over a slightly longer period of time?
That's all executable in FY23.
So this 40 crore itself should ideally become at least 175 crores. Is that a fair way to think about it?
I would say so. I mean, that's what we have. I mean, the business is all. I mean, we actually hope to do more than that. Business is all for this current year. This is not long-term business. So as I mentioned in my opening remarks, we are looking at a 4x plus revenue growth.
And over what time frame? Or 4x in this part of the business this year is what you're saying?
That's correct.
Okay. Thank you, sir, and best of luck.
Thank you so much.
Thank you. The next question is from the line of Viraj from Securities Investment Management. Please go ahead.
Yeah, hi. Thanks for the opportunity. I just have basically a couple of questions on the EV side of the business.
Viraj, can you be a bit loud, please? I'm sorry.
Am I audible now?
Yes.
Yeah, basically my first question is, just want to understand what will be the current level of localization and how is the ecosystem currently developed for the MCU business?
So, very important question. So obviously we have different frames. When I say frames, these are different model families. Mm-hmm. 3 of them have been fully localized. That means that all components that can be sourced in India are sourced in India, which is essentially all the mechanical parts and the assembly of the PCBA. As you are aware, the active and passive components are not really available in India, so it's not possible to buy MOSFETs or IGBTs or microprocessors or CAN ICs or stuff like that in India. They're not manufactured here right now. So those continue to be imported, but all of the value addition on the PCBAs is currently done in India, and the mechanical parts are all localized. The next 3 frames are scheduled for localization later this year and early next year.
So if one were to, kind of look at more of a 2 to 3 year period and understand the path to profitability, especially localization, because the frame itself also requires an increase in localization over a period of time, X of battery. So how should one understand the localization and the path to profitability? And a related question is, what kind of investments either we or our supply chain will be doing to achieve that?
So a couple of things. On the 3 frames that we've talked about, we've already done whatever we could do unless the ecosystem. You also asked about the ecosystem. As you know, the government is pushing very hard for bringing in microprocessor and other electronic component manufacturing into India. But these are not things that happen overnight. These are multi-year programs. I mean, this will be easily 4 or 5 years before we'll see the ecosystem change. So until that period, we'll have to continue to import these from Europe, the US, and partly from China. In terms of profitability, we will definitely be profitable this year itself. I mean, last year we were, if we were to look at if we had hit the revenue numbers that we'd wanted to hit, we would have been profitable last year itself. Because our biggest cost, obviously in a technical field like this, is we have other than material cost is manpower, and especially engineering manpower. And when you spread that over a larger volume, obviously you get a lot of efficiencies there.
Okay, basically what I was trying to understand is, how does the profitability or the margin structure evolve in this particular product category for us? I mean, not say over next 1 or 2, quarters, but I'm more talking about 2 to 3 years. And the investments you will require to kind of achieve those margin structures. So that was one. Second is on the order book. You talked about order book being, say, close to 200 crores. So the initial order we got from a large OE was around 60 crores, and we talked about a follow-up order of around 100 crores. So this customer seems to be accounting for bulk of our order book. So who is this customer, if you can share, and how are we looking at a diversification in terms of customer base, more from a sustainability point of view?
So let Atul answer the first part. Sorry, go ahead.
Jaideep, let me just do the profitability part. So let me just give you a sense. We are in a startup / ramp up phase right now, and I think despite that, for first full year of operations, last financial year FY22 was the last quarter of real operations, where there was absorption of e-vehicles for our customers, which also meant that we did well along with them. Now, for a first full year of operation in FY23, first 12 months of ops, we will be profitable. I won't like to hedge a number, but I can assure you we'll be profitable, albeit on a low margin perspective. Now, as and when the 2-3 things will impact the margin structure going forward, and we see a tremendous amount of visibility for that. One, the volume is going up, which means that when the volume goes up in this business, our buying costs we'll be able to negotiate better price on our components, and also work with our vendors on assembly, etc. Those costs will become more normalized. Currently, we are in a ramp-up phase. We want to look at customer satisfaction and customer acquisition. So certain costs are not really optimized, but we will do that going forward. Our investments, what we have done, are going to play out over a much larger volume. Maybe one can look at a 400 crore revenue for a marginal investment we have done. We have some capex plan this year also in that business. So we are not worried about profitability. I think we have a good visibility, and we are very confident that we'll be profitable in FY23, and going forward, these margin structures will only be more and more comfortable, more and more profitable. And this business is more tech intensive. We believe that we are single source to most of these customers we are working with, and it's a high spend product in the EV powertrain of any vehicle. It's high spend products, so the value we create in a vehicle is very large, which also means that the revenue we are able to generate is also very large. Jaideep, you want to talk about customer names and all that, because we have some issues on confidentiality.
Yeah, it's not. We have all of our customers require us to sign confidentiality agreements that forbid us from sharing names. But I think let me address the question that you had on customer concentration. Last year we were, pretty much most of the business was from one customer. As I mentioned, we have now got orders from 10 customers. And therefore, as these customers ramp up, our customer diversification becomes much broader. And we are also in discussion with other, like I said, up to another 30 odd customers for additional programs. So yes, last year was pretty much one customer. This year, that one customer will still be the single largest customer and will be more than 50% of our revenues. But as we go down the road, we'll see that pan out, and the customer concentration will be much less.
Okay, just two questions I had. One is, any arrangement, any clarity you can give on the status of the JV which we were planning to have with the Chinese partner. So if the FDI approval doesn't come through, any arrangement we have reached either in terms of royalty or technical fee payout. And related is, what further areas or applications in the MCU tech would we need support of the JV partner? Or, is the technology fully absorbed and incrementally there's not much to build upon? Any perspective you can share?
So, to answer the first part, if the FDI approval does not come through, we have an understanding with our partners to convert our agreements into a technical licensing agreement. So that we have a clear understanding there, and that's something that that if we do reach that stage, we'll be able to execute the documents accordingly. Regarding where are we on the technology absorption? I think we've done a fairly good job on technology absorption, and if you think about it, that a company that basically started not even 2 years ago or 2 years ago now, we've not only got orders, we've not only executed them, but we've also localized. I mean, that's a tremendous amount of activity and progress that's been done. I mean, in 2 years, and through COVID, when we've had shutdowns, we've not been able to travel and all of that. So there is a tremendous amount of absorption that's been done. But I will say that a good partnership, and in terms of also how we've worked with our partner, we've been successful because we developed the right product for the Indian market. We had the products ready, and that was a joint effort between the Indian partners and the Chinese partners. We surveyed the market, gave the specifications of the products that we wanted, and asked the Chinese partners to develop the product, and they developed them for us. Going forward, we may find additional applications that we want to go for. We may need to drive VA, VE. We may need to bring in additional functionality. So we don't look at this as being a static business. This is a very dynamic business. And while whatever we are doing right now, I think we've got a lot of knowledge, but we don't intend to stand still. We intend to work with our partners as well as in India on our own to constantly upgrade the technology and constantly bring out better products that our customers would find differentiated and better than that of competitors.
Okay, one question and I'll come back to you. If it becomes a technical agreement, will it be exclusive or,
It's 100% exclusive.
Okay, I'll come back in queue. Thank you and good luck.
I just want to make another comment of what we're trying to do with our motor control unit business. So there's a lot of talk about EV components. Our motor control unit is a pure play EV component. It is not a sheet body. It's not a stamping part. It's not a plastic part. It's not a tire or a wheel going into a e-scooter or a e-vehicle. We are doing products for the EV powertrain, which gives us a tremendous amount of customer strength and competitive capabilities and growth potential going forward. So it is a very highly tech part. And since, like Jaideep said, we've been working on this. This business is 2 years old, and we did a lot of survey and came up with a product which was ready for the market. But I think the work on that started maybe even 2 years before that. So we've been at it for 4 years, which has been able to allow us to get where we are. So once again, we are a pure play powertrain component maker. We are not doing seats. We are not doing a headlight for an e-scooter or an e-vehicle. We are doing a pure play component for that.
No, I mean, it's really heartening to see the scale up, and especially if you keep them in background, competitors like Bosch and others, who also compete in similar space and have a much more comprehensive suite of offerings. So in that respect, just trying to understand the differentiation and the capabilities which we have built. How do those differ versus the guys who have been in the powertrain space for decades? So that's where the questions were coming from. I'll come back in the queue.
I'll say one thing, and I hope I don't come across as being arrogant on this, but when people talk about experience, there is no experience in the EV business. Who has experience in the EV business? Everyone is new. It's a level playing field. Yes, we've got the competition in this space is. We've got some really good companies with excellent pedigrees, and they have the background in electronics and in software and so on and so forth. But please believe me, they've been selling products to the EV industry for 2 years or 3 years, as have we. The EV industry in China is 10 years old, not even that, right? So, Bosch doesn't have 30 years of experience or 200 years of experience in EV industry, or neither does anyone else. Their experience in the EV industry is very little, is limited. Absolutely fantastic company. It's a company that we admire and respect tremendously, but I just say, I genuinely believe that in the EV space, it's a very level playing field. Everyone's new.
Okay, I have a few more questions. I'll come back in queue. Thank you.
Thank you. The next question is from the line of Sonal Gupta from L&T Mutual Fund. Please go ahead.
Yeah, hi, good morning, and thanks for taking my question. So just carrying on with the previous conversation, and you in your opening remarks also mentioned about that you want to have a firmware component because electronics, whatever it is sort of going to get commoditized. So just, in terms of your strategy, what are you doing to internalize or improve on the software side? Just wanted to, and if you could also talk about, you mentioned that you will have some capex plans also on the EV side. So if you can just talk about that as well.
Okay. So right now the firmware is essentially built in China, but what we've already started this year is that the customization is being done in India. That means that while the basic algorithm and the basic heart of the program is what we've got from our partners, the customization of that to meet individual customer requirements is being done by us, as is the integration, the vehicle integration bit, which is the CAN communication bit. So those activities are being taken up in India this year itself. We also have a program to develop our own software, and that's an investment that we are making. And so the idea is that I don't want to get into too much detail and bore you with that, but the same product can be used in, let's say, a performance motorcycle or scooter, and can be used in, say, a passenger three-wheeler. But the drive characteristics are very, very different. And that customization is what we do. Customization is what I'm talking about, to say, okay, what's the acceleration, what's the range, what are the safety features built in. For instance, a scooter will have a feature that, if the side stand is down, you can't start the vehicle, and many other things like that. That's totally irrelevant in a three-wheeler. So those kind of customizations of making sure that the product fits the customer's requirement is what we'll be doing in India, and then obviously the integration, and then down the road, we are looking at developing our own software too. So it's a big part of our program, and in addition to our facility in NCR, we've also opened an engineering center in Bangalore, because as you're aware, that's the heart of the industry, of the whole software and electronics industry for us in India. One of the questions which came up earlier, and I'm sorry I wasn't able to get to that adequately. In terms of investments, we've got we've obviously got line investments in assembly lines and so on. We also believe that if volumes, and today our capacity is at 300,000 units, and obviously these are equivalent units. So we've taken one MCU, made that our base, and then we basically compute capacity in equivalent units. So our capacity is about 300,000 right now. We want to increase that a little bit more by the end of this year. And we believe that when we get to a volume of about 500,000 units, that we will also bring SMT capability in-house. So we will be putting in lines to do pick and place and reflow lines to do the PCB assembly in-house.
Got it. So as of now, the SMT is outsourced, right?
We work with EMS partners.
Got it. And just in terms of and thanks a lot for the presentation this time around. And the presentation also has a slide on EV vision. So could you talk about, are you looking to get into other components as well?
So yes, definitely. We are. We feel that motors is something we should look at. We do have partnerships with motor companies today, but we want to keep the option of motors open, but we just don't want to do what I would call a plain vanilla type of motor, because obviously the competition there is very, very high. So our motor evaluations are around technologies that are a little bit more differentiated, where the motor has a little bit it's not a normal permanent magnet motor, but maybe maybe a magnetless motor or something like that. So we are looking at certain technologies there. But in the meanwhile, we continue to work with motor partners very closely. We are looking at also at onboard chargers and also BMSs as potential products to get into. Being able to travel and being able to work on will obviously help us do that. So, but yeah, we're definitely looking at additional products.
Got it. And just a last point on this, like you mentioned, you're working with 10 OEMs already. So would it be fair to assume that you're working with some of the incumbent two-wheeler players as well? Not
yes.
just the startups, or is it primarily the startups?
We are working with both incumbents and startups.
Got it.
Across two-wheelers, three-wheelers, and LCVs.
Got it. And just on coming back to the fasteners business, like you mentioned that there is clearly a numerator-denominator effect, but you talked about getting back to 17-18% margin. So I just want to understand that given today's steel price levels, so what does that 17-18% of historical translate to?
I'm sorry, ladies and gentlemen, it seems we have lost the line for the management. We would request all participants to please stay connected while we reconnect the management line. Thank you. Ladies and gentlemen, your requested line from the management will join shortly. Please stay connected. Ladies and gentlemen, we have the line for the management reconnected. Thank you, and over to you, sir. Please go ahead.
Apologies.
Yes, sorry. Were you able to hear my question, or should I repeat?
Can you repeat that, please?
Sure. No, so I was talking about that for the fastener business, like you are saying that your aspiration is to get back to the 17-18% EBITDA margin that you've done previously. But given the numerator-denominator effect, I just want to understand with the current steel prices, what does that 17-18 translate to in today's steel price terms?
So if I'm able to understand a question, so steel is a full pass-through. I think it has gone up in the last 18 months or 15 months. It has gone up 4 times, and there's another 5th price increase that has come effective 1st April, 1st of May. We've been able to get full compensation from our customers for steel price increases. So that numerator-denominator will be an issue to be able to resolve that, and that can only happen if the steel prices falling, everything remaining constant. Let's assume for a minute we are able to get some conversion costs or inflationary cost increases from our customers. Then obviously that will change that numerator-denominator factor again positively in our favor. So we believe that we have a path to going back to 18% over the next year or two. It will probably take us 12 to 24 months to get there. For these 2 reasons we talked about. Second is we have a very aggressive cost control, B, also an efficiency improvement program in our operations. So we are looking at various ways how we can optimize in everything we do. And that's a constant thing we do. And I think we have identified some more opportunities for this financial year also. So all these 3 factors will help us take us back to 18%.
Got it. So what I'm trying to clarify is that 18% holds even if the steel prices remain at current levels.
Yes, like I said, even if prices remain at same levels, in the next 12 to 24 months, we'll be back at 18%, yes.
Got it. And just could you talk about like clearly the what sort of like you mentioned that the commercial vehicles is one area where you see strong growth. Similarly, I mean like on the passenger vehicle side, I mean we had signed up some new OEMs as well. I don't know if you want to talk about that and how the ramp up is happening and what are your capex plans for the full year?
So our capex plans are very, very small this year. About 20 odd crores of rupees. They're not very large, but from a customer, where's the growth coming from? Yes, a lot of growth will come this year on commercial vehicle business. We have not only from our existing customers for products we have developed for them in the last couple of years, which are going to give us a full year revenue. Second, we are expecting a lot of growth to come from our passenger vehicle customers, namely primarily Maruti. There's a lot of momentum there. Their own numbers momentum. Secondly, we've been able to develop more components for them, which were not part of our kitty earlier. So that would bring us additional revenue. Lastly, we feel we'll get a lot of growth coming in from our tractor business. We acquired John Deere as a customer about 2.5 years ago. So I think there's a lot of headroom to grow in that customer. Plus, we are growing very strongly with Mahindra and Mahindra tractor division. Lastly, I think we always try and forget it. Our aftermarket business is very strong. We had a 20% jump in revenue last year, just on top of another 20% the year before that. So we have a lot of tailwinds on our aftermarket business also. We expect substantial growth to come in that segment as well.
Got it. And just the capex for the EV business side, could you sort of talk?
Yeah, no, it's marginal. It's marginal. If it's not that. It's not differentiated across into segments. It's a common capex. A lot of it this year, the capex what I mentioned is a maintenance capex. More, it's not really huge amount of capacity build-up capex. It's more maintenance capex.
Got it. Great. Thank you so much. I'll join back. Thank you.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for opportunity, sir. Sir, in fastener segment, what is your current capacity and capacity utilization? And how much was revenue versus volume growth in FY22?
So I think in FY22, we had a 33% top line growth. I think we have about a 20% volume growth.
Correct.
In FY22 as part of that. So it's not a growth because of inflationary reasons only. It's been a growth on volume as well, and I think the volume number was very, very heartening to know what we were able to achieve. To answer your question on capacity, it's a long discussion, Abhishek, but I don't want to get into text of the whole thing. But let me assure you, with our fourth plant in Bangalore live, and the capex we have done in that facility in FY22, all our plants are at pretty much equal capacity. So we have the capability to bump up our revenue on current price structures. Maybe we can even touch 750 crores with that revenue on current price points and current. I think we have a lot of opportunity within the system if the market allows us, and we are able to do a good job in sales. We can capitalize on the opportunities given to us. The capacity conversation is much longer. I'm sure we'll set up another call and take it with you.
Okay. So as I know that your capacity is around 65,000, including your Bangalore plant. So how much volume was in the last year in FY22?
Can you repeat that last part of the question?
So how your current capacity is around 65,000 metric ton, including your Bangalore plant. So just wanted to know that how much volume was in FY22 and how was the mix special versus standard fastener?
So I don't have hard data on that right now. We'll prepare the data for what you need. I'll tell Pankaj to take it up in a separate call with you. But I want to show you our product mix for more special components as a percentage has only gone up in the last 1 year, and that's why we are able to do what we do in terms of selling prices. So and customer acquisition, customer development. So like I said, Pankaj will get into hard numbers with you in a separate call.
Okay, sir. So how is the mix is changing, special versus standard fastener right now?
So special is going up vis-a-vis standard. I don't have the exact data with me right now. Pankaj, can you prepare that data?
Yeah, sure. Abhishek, we will circle back with you.
Okay. And sir, as you mentioned that you have an order book around 170 crores in the MCU segment. So how much revenue are targeting in FY23, and what would be the break-even point?
Sorry? Could you just repeat that, please?
I'll take that. So we are expecting anywhere from, on a conservative basis, we're expecting a 3 to 4x growth over FY22. We did 38 crores last year. We hope to be profitable this year. The break-even points are too early to look into that business because we are, like I said earlier, we are in a customer acquisition phase, we are in a customer satisfaction phase, and a ramp-up phase. So these numbers are not normalized for us to arrive at break-even points, but I can assure you we are already, as per our understanding and as per what we know of business right now, we will be profitable in FY23. With the numbers we have, it's like Jaideep said earlier, it's a very dynamic business in terms of tech capabilities, assembly capabilities, FAME2 rules, etc., etc. But despite all these things, we will be profitable. But finally, to arrive at a constant break-even number is early days for that.
So, as you mentioned that you have a current capacity of MCU is around 300,000 vehicles. So, what would be the peak revenue and what is the content per vehicle right now?
Can you repeat the last part again?
So, what is the content per vehicles in MCU right now?
So, the content of the vehicle can vary from 9,000 rupees to anywhere lakh and a half or two per vehicle, depending on what segment of the industry we are talking about.
So I'm talking about this.
Two-wheeler starting from 9,000, going to a bus, public transport vehicle, about 2 lakhs roughly. So it depends on what customers we are working with.
So I was talking about the average realization of the MCUs.
So just to give you a sense, currently bulk of, if you see what's happening in the industry, in EV industry in India, bulk of the absorption of e-vehicles is happening in the two-wheeler space. bulk of our revenue is coming from two-wheeler space. We have customers in the three-wheeler space also, and the public transport space and the LCV space, but their volumes are very small. So the revenue per product may be high, but the units are very small. So we have not done any thumb ruling on that. Like I said, currently in a ramp-up phase, we are not looking at a basket. We are looking at building technical/customer acquisition capabilities. So, but having said that, FY23, bulk of the revenue will come from the two-wheelers and three-wheeler space.
Okay. My last question is related with the margin side. As you mentioned that mix will improve in the commercial vehicle segment in FY23. So will it help in the margin expansion? Because historically we have seen that you had achieved the margin of around 18 to 20% when the contribution of CV was quite high.
So yeah, CVs will definitely help. The good thing about the CV business in the fastener category is they bring a lot of top line growth. They buy large volumes and large values. So obviously that helps us amortize our costs across a larger pie in terms of volume and values. So if CV picks up, definitely it will help our margin structures going forward.
And what is the impact of the increase in the power cost right now?
So short term, I think the power, Pankaj, you want to comment on that? Exactly, you have the numbers.
So I'll say the inflation as a bundle total has impacted adversely about 2.5%. So power is a part of it. So I'll guess around should be about 1.5%, because that's a major contribution of the inflation to power and fuel.
But that's it. If there's a power, that numbers will go up in case there's a dramatic power availability or power shortage through the grid. Then we have to rely on our diesel genset, where the cost has gone up dramatically. But we are hoping that power availability will stay healthy as we have seen last year.
So there was the impact of the around 250 bips quarter on quarter because of the change in the increase in the power cost.
No, that's that is included in that. It's a bundled, inflation on commodities and power, fuel, chemicals. It's a combined impact, right?
Okay. Thank you. That's all from my side.
Okay.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit a question to 2 per participant. If time permits, you may join the queue for any follow-ups. Thank you. The next question is from the line of Nitin Dharmawat from Aurum Capital. Please go ahead.
Yes, thank you for the opportunity. Am I audible?
Nitin, your voice is not very clear. It's muffled. Can you please use the handset?
Yes. Am I audible now?
Yes.
Thank you for the opportunity. Couple of questions. So what is the current capacity utilization that we are having both in fasteners as well as in EV business?
Like I said in the call earlier with other members on this call, yes. The capacity utilization is a long conversation. You need to understand the product mixes, capacities, customers, customer segments. So I suggest maybe we can set up a separate call with you to get into that. On the EV side, capacity, like Jaideep said, is 300,000 units right now.
Got it. And second question is about the inventory levels, which have gone up last year. So you mentioned that you will be having a better management on this. So what was the reason why it has gone up last year? Any specific reason?
Nitin, I'm a bit surprised with the question though, that because if you're talking about faster business, of course, then there has been a reduction in the inventory overall. We can get into the numbers maybe on a one-to-one call.
No. So sorry about that. For the confusion, I am not referring only to March 22 number, but March 21-22 number. So from 60 crores to it has gone to almost double. So that is the number I was talking about. That delta I was talking about, and it remained over there. So it has come down last year marginally, but overall in last 2 years it remained almost 100 crore plus kind of number. So that is what I was referring.
So I think it will require a relook at, because you'll have to see number of days of holding of inventory. Maybe
okay.
that could be because we have to see the volume revenue top line also.
Got it. And the third and final question is about who are our leading competitors in this space, EV space I'm talking about.
Right now, the only companies in India, I mean, there's a wide range, but the only companies that are actually selling large production volumes would be Mahle and maybe Hella and Bosch maybe a little bit. So, I mean, these three companies, most other companies have not been able to industrialize the products yet.
No, if I want to add what Jaideep is saying on top, I think compared to Mahle and Hella, I think we have a larger volume we are clocking because of the customers we are attacking. Now, a lot of the there's a lot of large segment of business which is there in the low speed scooter range, which is not a market we are addressing, but that's a very commodity market with low price points, etc. And I think the future is not low speed scooter. Future is only the high speed scooter or high speed two wheeler. Let me rephrase that. So, in the sense with the customers we have acquired, incumbent and startups, I think we probably have currently. We believe we have the largest market share.
Yeah. Got it, sir. Thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Chetan Ginodia from Alpha Credit Advisors. Please go ahead.
Hello, sir.
Yes, Chetan. Please go ahead.
Yeah. Hi, Atulji. This is Amar here from Alpha Credit.
How are you doing?
Yeah. After a long time. And thanks a lot, Atulji, for arranging this call. I think this is your first conference call.
Correct. Like I said in the beginning, in my opening remarks, this is a new beginning for Sterling, and we hope to continue this effort going forward. So maybe after 3 quarters, I won't say this because this is the first new beginning. We're already on our way then.
Yeah. Congratulations for this, and thanks a lot, for arranging this call. This actually gives a lot of insight. And I'm sure, in turn, you will also get benefited because a lot of investors will ask a lot of intelligent questions and that, you can obviously incorporate in your business. So I have 2 questions, Atul.
Learning all the time. We learn more from you guys than what you guys learn from us. So I look forward to these calls, and they always add tremendous value to us.
Yeah. So Atulji, 2 questions from my side. Mm-hmm. Number one is this JV, that EV JV. What is our stake in this JV?
See, currently, this JV was supposed to be a 56-44 in our favor, but the JV was signed pre-COVID March 2020, and then post-COVID March 20, before the JV could actually crystallize into formal shareholding patterns, Government of India put the FDI rules in place, wherein every investment by Chinese company had to go through the FDI process. Now that FDI process is running very slow. It's a very difficult process. There's no clarity as to what's happening on that. So currently, long and short is Sterling Tools owns 100% of this company. It's 100% subsidiary of Sterling Tools.
Okay.
For now at least.
Yeah. So let's say if this structure remains, so you have to pay some royalty to the Chinese company?
So what our like we said earlier, our effort is, if this status remains long term, we would probably move our relationship with our partners to a tech relationship. So yes, that's our endeavor because we want to keep both the parties motivated, and they've been a great support to us. I want to put it on record for all our investors that our partners have been a great support to us, despite the fact that FDI did not go through, despite the fact there's no travel between India and China, and despite the fact that everything happened on video calls and phone calls, and the text transfer happened through video and phone call and emails, etc. So we want to keep this current level of healthy relationship and build on it, which is mutually beneficial for us.
Okay. Okay. And secondly, sir, the content per vehicle, which when I met long time back, it was something different. So I believe now the cost and all has increased. So content per vehicle for CV would be like what? Currently, like earlier it used to be 10,000. So after the cost inflation, it would be something around 14,000.
The content per vehicle, I would still do a thumb ruling in the two-wheeler space at about 10,000 odd. Is he talking faster? No,
Two-wheeler, you are saying 10,000?
Yeah, give or take. So depending on the product specs a customer wants to build and the user experience the customer wants to give their consumer, so it can range from anywhere from 9 to 15,000 rupees in the two-wheeler space.
Sir, I'm a little confused because earlier, if I'm not wrong, the content per vehicle for two-wheeler used to be around 1,800 to 2,000 rupees. So you're saying it has gone up?
No. Are you talking about the fastener business or the motor control unit business?
I'm saying fastener business.
Oh, okay. No, so fastener business content still remains the same. There's no value may have changed because of steel price increases, but the volume, etc., remains constant.
Okay. So thumb rule, like, in a CV, content per vehicle would be like what, 14,000, 15,000 odd?
More than that, 15,000 plus.
15,000 plus. And let's say for two-wheeler, it would be what, 2,500 now?
No. Two-wheeler, our sense would be about 500 to 600 rupees.
Okay. And PV, around 4,000?
Passenger vehicles, and depending again, the kind of customer or the kind of vehicle you have, anywhere from 5,000 to 7,000 rupees.
Okay. And the tractor would be what, 7,000 to 8,000?
Yeah, about 7,000 to 12,000 rupees.
Okay. Tractor would be around 7,000 to 12,000 rupees. And now you are saying this, for EV particularly, you were saying that the content per vehicle for this product would be around 20,000 rupees, right?
No, I didn't say that. I said for a E2-wheeler, the content for the motor control unit can anywhere range from 9,000 to 15,000, depending on the product specs.
Okay, 9,000 to 15,000. Got that.
And it can go as high as 2 lakh rupees for an electric bus.
Okay. Yeah. Okay. And sir, out of the total fastener business, how much would be the engine fasteners today?
I think I would say close to 30% revenue comes from my engine fastener business, 25 to 30%.
Okay, 30% business. And sir, about the margin recovery, you indicated that something around 4% of the margin got impacted because you were not able to pass on the price and all those things. So at least going into the Q1, we should expect some margin improvement, let's say 400 basis points, because ultimately you'll be able to pass on prices and global steel prices start coming down.
So, Amar, we did not say that because we were not able to recover, we had lost 4% margins. What we said was, we have been able to get full compensation from our customers for steel price increases.
Okay.
Now, because of the numerator-denominator effect, which I'll tell Pankaj to explain to you in a separate call, you can set up with you, it's about 3%. So, if you're selling, let's say, okay, for everybody's interest, if my current selling price is for 100 rupees, and my raw material content was, say, 40 rupees, steel was 40 rupees out of that, steel goes up by 15 rupees, my selling prices become 115, but my buying prices become 55. So earlier the RM content was 40%. Now when my steel has gone to 55 rupees and my selling price of 115 rupees, my RM content goes to 47%. So it's pure mathematics, which is impacting the so-called margin numbers. Now, having said that, let me park this for a moment. Where we have lost maybe 1% or 2% is we have lost margins because we were not able to get conversion cost increases due to inflationary pressures on chemicals, on energy, on phosphating chemicals, on zinc, etc. Other value addition we do on the shop floor. That inflationary impact, we were not able to get compensation from the customer. So they're two separate parts of the thing.
Okay. Thanks a lot, Atulji. Best of luck for the future.
Thank you.
Yeah.
Thank you. The next question is from the line of Karthikeyan from Suyash Advisors. Please go ahead.
Yes, thanks for the opportunity. Couple of questions. One would be, can you talk about the outlook for exports in the standalone business or the parent entity business, and the role Mado can play in that? And the second question would be the pathway for indigenization. You spoke qualitatively about this, what is the current import content in your MCU business, and how do you see that evolving over a period of time? Thank you.
So let me take the question for the fastener business, and I'll hand over for the MCU to Jaideep. We have a relationship with Mado, which is about 4 to 5 years now. If you see, we have grown with customers like Maruti and Honda over time, because we were able to develop some products for these two Japanese customers, and you know how the Japanese Keiretsu system works. So we were able to optimize our Mado relationship to build a product line for these Japanese OEMs. So that's where we have had the benefit on that. To answer your export question, I think we did about, I don't know exact numbers, but percentage, we did, I think my sense is about 10% odd revenue last year. And our visibility going forward is similar or around that only. So we are keeping in mind everything and the headwinds in Europe right now. We are not looking at substantial growth in this area because most of our customers were European based.
Sure.
Okay. I already addressed the localization, that different frames have different levels of localization, but the ones that are selling well are localized to the extent that they can be localized. All mechanical components are localized, and PCB assembly is localized. As you're aware, active and passive components are not available in India and have to be imported.
Can you quantify that for context? In value terms?
Again, depends a little bit on the product portfolio, etc. But I mean, I won't have that exact number, and I have to look at that. Maybe we can get back to you on that. Looking at one or two of the better, higher selling models.
Sure. One quick question on the order backlog breakup of 175 crores that is indicated. What would be the split between two-wheelers and other categories of vehicles?
I would say 80%, more than 80% would be two-wheelers. Maybe 10% would be three-wheelers, and 5% would be others.
I'm asking you this question because if I take average numbers, the volumes seem to be in the range of 175,000 two-wheeler units, broadly speaking. So, is that a reasonable estimate, or do you think I'm getting some numbers wrong?
Sorry, I didn't understand the context of 172,000.
No, I said if I assume an average price per unit for you for the MCU, and your outstanding order backlog, it seems like you'd be supplying a substantial number of, the two-wheelers sold, high-speed vehicles sold. So I'm just trying to understand.
Like I said, it's 80-85% for sure.
Sure. Thanks, and very best wishes.
Thank you. The next question is from the line of Shreyansh Gatani from SG Securities. Please go ahead.
Hello, am I audible?
Yes, you're audible. Please go ahead.
Hi. So my question was around CapEx. So with the strong traction coming for your EV business, are you looking at, so as you mentioned, it's only 20 crores of CapEx this year. So if you're able to do 170 crore in revenues next year, would the capacities be utilized, and pre-planning for any CapEx for the demand that will come from the 30 odd customers that that might convert into leads that might convert into customers. So just around that. And the second question was around the current royalty sharing with your Chinese partner.
So if I can, let me add a little. I think the number I mentioned, 20 crore odd capex, was for the fastener business. That does not include the capex for our MCU business. Having said that, we have a capex plan of 10 odd crores in that business for this year. But like I said, it's a very dynamic business. It's under constant review. We are getting new successes on a regular basis, and these numbers are revised accordingly as we go forward. But I like Jaideep said earlier, we will do more capex in SGM in our MCU business, depending on the customer traction, depending on the FAME2 rules, and finally to build adequate competencies both on firmware and hardware side. We might look at putting SMT lines in future, which will require additional capex as we go along. But that's early days as yet. But I'm just sounding out to you what the future looks like from a capex perspective in our MCU business. And you had one more question. If you want to repeat the question, yeah.
Yeah. So what's the current revenue sharing or royalty structure with your Chinese partner for the MCU business?
So currently there is no formal understanding. We are awaiting. This requires a lot of discussion with them, a mutual agreement. We were hoping that travel opened into or from China, but I think we don't see visibility in the next 2-3 months. But that's a conversation we want to have with our partners physically, because it impacts a lot of action points after that. So we'll keep you posted as soon as we arrive at an understanding on that.
Okay, because you're going to do about 150-160 crores in revenue. So like currently, is it just like purchasing the product from them and adding on top and then selling it to the Indian industry, or how does that work currently?
You captured it correctly, but I want to re-emphasize again the value we add on top. It's not as if we are just it's the screwdriver stuff, parts coming from China. We put it together and ship it. There's a lot of software. There's a lot of testing capabilities. Like Jaideep said, EV is a new industry segment altogether. There's not enough data behind it. So there's a lot of testing, validation, customer interaction, customization, localization work which is done at the India end, and on top of that, a lot of the software customization is done in India, but our own tech teams here in Bangalore, tech center, and our plant here in Faridabad. So there's a substantial amount of value addition being done, which to my mind can't be quantified. It's maybe as important as the products coming from China.
Okay, thank you.
Thank you.
Thank you. We'll take the last question from the line of Hitesh from Aksa Capital Advisors LLP. Please go ahead.
Hi, thanks for the opportunity. So just want to understand a bit more on your Bangalore expansion, because I believe this expansion came sometime in 2018-19 is when this facility got commissioned, when we had a scale of about 450-500 crores. Today, on an elevated input price, our scale is again around the same levels, but we are still looking to double the capacity there. So just, wanted to understand, the rationale for this.
So, good question, Hitesh. We commissioned the plant in, I sense, October 2019. So we had decided to put up the facility in the financial year 18-19, maybe I think 17-18 itself. As you know, that 18-19 was a peak year in the automotive industry. We had a lot of opportunity with our customers. We lost a lot of business because of lack of capacities, and we looked. That is what gave us the visibility of the business going forward, and the lead times for us to optimize any facilities anywhere from 3 to 5 years. So we put up that facility, which went live in August 2019, and we continue to do capex here. Like I said a few minutes back, bulk of the capex in Bangalore has been done till FY22. There's some balancing capex which will happen this year. That plant is as big as the facilities we have in North India. Now, and your question is well fair, that why our top line revenues is similar to 18-19. What we did in 18-19, we were pushing our facilities in NCR plants to do those numbers. We had to buy out some parts from other vendors outside our facilities and process them inside. We didn't want to be in a position again to do that. We wanted to have capacity on the plus side, so that we can optimize or capitalize on any opportunities we walk through our doors. At the same time, it is also our objective to mitigate the risk of all our facilities being in the north, give customer confidence to our customers, including these risk mitigation strategies are particularly done very closely by the likes of Maruti and Honda, because they lost a lot of production on account of fire at some vendors' place where they had to shut down themselves for a few weeks. So that was one reason we had to put another facility. And finally, we wanted to go to a new geography to add confidence to our all national customers. We have a large amount of business. We come from south and west. So we wanted to give them showcase facility in south to add customer confidence. And finally, all the learnings of our north plants have gone there. We believe our Bangalore facility is a digital 4.0 facility, is an IoT facility. It's a facility which is truly world class. We believe it's the best fastener plant in India and probably one of the better ones in the world. So we are building our future. Fortunately, if you look at our balance sheet from a cash position, despite those investments, we are still almost net debt free. We carry very little net debt. We have generated a lot of cash during COVID years also, and we are building our future. We are not thinking quarter to quarter. It takes, like I said, 3 to 5 years to optimize the facility and give customer confidence. So we are here for the future. We are here for the long term. We see tremendous headroom for our growth, which has already come to us in FY22 and 23-24 going forward.
Sure, thanks. And just my last question is, sir, on your JV partner, I just have access to some of their numbers, slightly dated, but this was sometime in 2015, 2016. They had an EBITDA margin of about 23%, okay? And again, looking at their asset base, on a low asset base, they were doing anywhere close to 200 million yuan. So just trying to understand, in this particular JV for MCU, now, should we also be able to ramp up the scale there? Can we inch closer to this kind of a margin, about 20-odd%?
Well, obviously that's the objective. A lot of work to get there.
Okay, sure.
But I think the one thing that we recognize is that this is a low capex, high ROCE business.
Mm-hmm. Sure. I think that's it from my side. Thank you.
Very different from our fastener business, which has significantly higher capex and lower asset turnover. Here, it's an engineering business. It's a technology business.
Sure. But does this also have an application outside the auto industry, in the industrial side, or is it only restricted to auto industry?
So, GTEC's origins were they used to make AC drives.
Right.
And that's how they got into electric vehicles 10 years ago. There is an opportunity for us to do those kind of drives for India also. In fact, the GTEC has got a lot of experience in selling those drives in India, and had a partnership with a leading company in India for such drives in the past, which has since been dissolved, and therefore we are looking. We may look at it in the future, but that's not. It's not something which is in the short term. Right now, our focus is on the EVs.
Okay, sure. Got it. Thank you very much.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to Mr. Atul Agarwal for closing comments. Thank you, and over to you, sir.
Thank you, everybody, for your time. Like I said in the beginning, this is our first initiative, and we hope to build on that going forward. We'll continue to have calls and visits and more communication. I think Sterling is a different company today than it was a few years ago, especially with the addition of the motor control unit business. It provides us not only organic growth from a traditional coal forged fastener business, but I think we've entered the space, a new space in the EV powertrain business, and with a product which is very advanced with a high spend and we see a lot of momentum on that. We believe that business has the potential to be bigger than our fastener business over time, and not only, and will give us the visibility to add more product lines in the EV space going forward. Pankaj, I, and Jaideep are available to you anytime for additional information you may need. Please reach out to any of us, and we'll try and address any questions you may have, which we not be able to address today. All the best, you guys, and we hope to see you guys again in the future. Thank you.
Thank you. Thank you.
Thank you very much. Ladies and gentlemen, on behalf of Sterling Tools Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.